Hello, everyone, and welcome to Business Morning. We're live to you this Thursday from our studios in downtown Lagos, Nigerian Stock Exchange. I am boasting them for you. Let's get the show started. The Nigerian Stock Exchange yesterday, of course, held a few days ago, held its annual general meeting. The company reported a surplus of about 2 billion naira for the period ended full year 2018. That was one of the big stories so far this week. Then, of course, you go back to the financial system, the bigger banking system, where the financial regulator, the Central Bank of Nigeria, on Monday drew the curtain, which was the 30th of September, drew the curtain on loan-to-deposit ratio minimum threshold for all banks to comply with. Of course, we're getting news overnight that 12 banks failed to meet that deadline. And also you remember that the regulator have set a new deadline and a higher threshold of 65% effective. Everyone has to comply with that December the 31st. But of course, with the September 30th deadline, which was on Monday this week, yesterday the central bank says 12 banks will be penalized close to 500 billion naira. 499.175 billion was what was reported in the news overnight. And that's one big story that everyone is focusing on this morning. The 12 lenders will be debited via their respective cash reserve ratio. That's the money with the central bank. On Monday, the central bank raised the threshold to a new higher level. Then what we had yesterday, the 12 banks, 4 of them were Tier 1 commercial banks, 3 were foreign banks, 5 of the 12 are listed here on the Nigerian Stock Exchange. And that's the big story this morning. Yesterday, the shares of GT Bank was down 7.58%, FCMB lost 3.03%, UBA lost 1.63%, and Zenith Bank shares dropped 1.60% on Wednesday, on the day that the central bank took that action. We have this as part of the big story we're covering for the Nigerian financial system and the market since independence. And we're having this right here at the Nigerian Stock Exchange, what we call the home of capitalism. And joining me for this conversation this morning is the Chief Executive Officer at Financial Derivatives Company, Rewane. He's also the economic consultant to Channels Television and a member of President Buhari's Economic Advisory Council. We're live here with this conversation. Mr. Rewane, good morning.
Good morning.
Thank you for coming. This is as big as it could get. I'm sure everyone will expect that before September 30th, the central bank will wield a big stick, and it did that yesterday.
Yeah.
How would this really work? Overnight, I've seen folks sending messages on social media. How would this really work? Would these banks, 12 banks, lose this money? How will it really work in practical terms?
No, they don't lose the money. You see, there's a shortfall. It depends on how you compute your loans to deposit ratio. So, first of all, there must be some computational problems. Secondly, 500 billion naira as a percentage of total loans of about 16.3 trillion naira is nothing. So the money goes from your account, which is interest-bearing, to a non-interest-bearing account, which is a cash reserve ratio.
For each of these banks?
Each of these banks. So it will affect your cost of funds, it will affect your net interest margin, it will affect your return on investment. So what can the banks do? The banks now have to increase their loans so that they can bring up their loan-to-deposit ratio up to 60%. If they comply with that, then they will now ask for a refund from the central bank. Getting a refund from the Central Bank of Nigeria is it's easier to put 50 flies in a matchbox than to get a refund from the Central Bank of Nigeria.
The reason why we're trying to get your professional view and insight into this is before folks on the street begin to panic when they see these names go in the press, in the newspapers, and online, and said ABC banks involved, so below be penalized, and folks want to go for panic withdrawal. That's why this is necessary for everyone to understand this penalty or sanctions.
500 billion naira is nothing compared to the size of these banks. These banks are put together trillions of naira, right? So 500 billion naira is nothing. And it's not that they are losing the money. They are taking the money from where they can earn interest to where they are not earning interest. It will still be part of their balance sheet, or it will be classified as cash reserve with the Central Bank of Nigeria. They have the money. It's not a liquidity threat. It's not a profitability threat. It only means that they have not complied at the point in time with the supposed 60%. And I can assure you that most of them think they've complied, but the central bank did not accept what they call loans. So that way, if they back off those loans, then you will be in default. So it depends on how how you read it, but definitely it's not a panic.
So the penalties or the sanctions is basically sterilizing this money away from these banks.
Absolutely.
And the money is still safe with the central bank.
Absolutely, and the banks are safe and sound.
Okay,
the last thing the central bank wants to do is to send a wrong signal. So I think it's good that...
It's good we clarify this
yes.
for the public. It's not. So each of those banks are not losing these billions of naira, which everyone is seeing in the news since yesterday night, these dozens of billions of naira. Again, if we look at what the central bank says, it said, the regulator said on Monday that it shows appreciable interest, more growth in loan growth by banks between the period.
5.3%, 5.33% to 16.5 trillion naira was what it had. But now they want more. As a matter of fact, they've now increased it to 65%.
Yes.
So for December, what will it do? Banks will have to make loans. But it's not that easy to make loans. And you're talking about loans to the small and medium-scale enterprises. So what the central bank is trying to do is to de-risk the sector a little bit by making sure that they name and shame those who are defaulting. But again, it's not just risk of default. It's a question that if the economy is not growing, if business and investments are not coming in, then how do you make loans? So the banks are being cautious, and rightfully so, by not just throwing everything out there.
To every man on the street.
Absolutely.
Because it's someone, each piece of money in the bank is someone else's money.
Absolutely. So,
someone else put it there. So you've got to make sure when he makes the call, his money is ready for him.
That's right. Banks are prudent by nature and they're conservative, so they would take their time and they would comply in due course, but they have to be careful about it.
Interesting, if we take all this back to Nigeria's history at 59, and we're trying to look at the financial markets. We're here around Tinubu Square where it all started, the setting up of the central bank just about 2 years or so before independence, and then we saw the evolution of the financial system. Take us through the timelines over the last 5 decades, the evolution of the financial system and the markets.
First and foremost, let's talk about legal tender. We went through the question. At that time, Nigeria was using the pound, the British pound. So we had parity. The Nigerian pound was, one Nigerian pound was equal to one British pound. We're part of the Commonwealth. Then Nigeria broke ranks with Britain in 1966 and had the Nigerian pound with a different value from the British pound because the British took the markets by surprise and devalued the currency. Now, by January 1973, Nigeria then went into the naira, the pound to naira, and also moved to a metric system. We had pounds, shillings, and pence, and we had inches, yards, and feet. We now moved to a metric system. We started driving on the right-hand side of the road, and we also went to 2 naira was equal to 1 pound. Then we moved from legal tender into checks, right? So you had people, they had coins, you had special cash, and then you had checks. Then from checks, we now moved all the way to near convertibility in the foreign exchange market and also began to build around electronic payment channels, POSs and all that. What does this mean? 59 years in a life cycle of a nation is nothing. That's a baby nation. We are talking about nations with 500, 600 years. Even within the Nigerian context, there are nation states within Nigeria, Kano, Warri, Benin, Calabar, where these nation states and tribes have a history of 600 to 700 years. So the 59 years of corporate entity of Nigeria is nothing. Now, what does it mean? Is this country maturing, right, in terms of its business practices? We've had a pension scheme which mobilized savings. We now have about 9 trillion naira of pension money in a money supply of 27, 28 trillion. So about 30% of your money supply is locked in pension money. All right? And you look at the stock market. So 1, you've mobilized savings. 2, you've opened up asset classes, which is the equities. You've opened up the bond market. So you've issued 30-year bonds, 10-year bonds, and 5-year bonds. This is all. But the thing is that it has to all come together to have an impact on the lives of ordinary Nigerians.
That's the question. The role of the financial markets in economic growth and development. The first development bond, also which was done with the central bank then, even before the SEC and all that, was all about building infrastructure and what have you. So the first national development plan, the second and the third under Rewane and other leaders back then, was to use the capital market. And that was why the SEC came out of the central bank then. And the idea was to look for long-term capital that will help develop the economy. If we look at the markets over the last 5 decades or so, or about 40 years, do you think we've been able to use the markets to actually develop or grow the economy?
No, not effectively. What you have done here, you have put the building blocks. But let's go back. Do you know that during the Nigerian Civil War, Chief Awolowo, as the Minister of Finance, actually issued the first bonds to fund the Civil War? Every Nigerian worker had to cover part of a salary as a war bond, and the Nigerian government retired these bonds after the Civil War, judiciously and punctually. That was the first sign that a country was a responsible country under Chief Awolowo as the Minister of Finance, God bless him, right? So you've come all the way to this point now where the people are looking at the Nigerian government issuing bonds, sukuk bonds and all of that, and are meeting their obligations. There's fiscal consolidation taking place. Now, how do you convert savings into investment? And how does investment lead to growth and creating jobs? That's where we are.
Where's the missing links here?
No, it's transition. You have to do one first, and it's a sequence. You have mobilized the savings. Savings are probably more in the involuntary savings scheme, that is the pension funds. But the pension funds are not going to throw their money away. They are now looking for actuarial investments where they can now invest life policies and all of that, 20 years, 30 years. Then when you now use this to fund infrastructure projects like rail, refineries, power stations and all, then you begin to see the impact. 1, investment. 2, jobs. And 3, increase in productivity and output.
If we look at the milestones and the evolution of both the regulatory institutions and the financial markets place and the players themselves, do you think 50 years we've had a very dynamic financial system and market with programs and policies, even than the broader economy?
Yes, but the problem is that the institutions themselves are not that strong. You've had people being fired, these changes and all that. When you take a country like Ghana, a country like Ivory Coast, in the West African sub-region, the institutions are strong and stable. Nigerian institutions have not been. We're just getting to that stage where we are beginning to respect institutions. Now, when these things are stable and we can enforce contracts and you now begin to see that we will get to that stage where institutions are strong and they begin to drive, together with good policies and forthright leadership, you will begin to see the impact. But this is a $450 billion economy. It's a big, big elephant. To turn it around even 1 degree or 2 degrees takes a lot of work. So alignment of goals between regulators on one hand, policymakers on the other, because at times we confuse the two. There are policymakers, there are regulators, and then there are markets. The intermediaries between the policymakers and the regulators and the markets are the financial institutions. Those financial intermediaries, like what we just talked about, the 12 banks and all that, the policymakers sends out signals and then enforces those regulations, and those regulations now transmit to the market. What you and I are talking about here is to tell people that don't panic, there's nothing wrong with the banking system, this is just a penalty and it's nothing in terms of materiality. But it's important that we realize that we are looking at an evolution of a system. At times there'll be hiccups. And then you back up and say, okay, in this 50 years, we've had at least 3 or 4 recessions. We've had commodity collapses. We've had the market go all the way up and all the way down.
We've had a number of bank closures.
Now, consolidation in the industry, we're seeing that going to happen in insurance soon. However, we have not been able to see output growth. Output growth is still 2%. Potential GDP growth is actually about 4%. So we have a recessionary gap. And now it's time to make some very hard decisions. We could model through, but modeling through means that you continue to be suboptimal. But if you are going to take some very hard decisions, like I said, the options are few, the choices are hard, and the outcomes are uncertain.
You look at the growth in the financial system and the financial markets over the last couple of decades, and when we saw 24, 25 banks down in one day under the failed bank decree of the late head of state, Sani Abacha, back then a few other banks collapsed, and the consolidation from about 200, 189 banks, today about 25 to 30 banks. Then we saw the stock market meltdown as well. A number of brokerage firms also went under, also in the insurance industry. So, where do all these jobs and businesses go? Is this a function of the broader economy? Perhaps we need to have 1,000 banks, 500 banks today, if there's an argument.
Some industries consolidate, some fragment. It depends on how things go. But what you must know is that the maturity, industry life cycle maturity, shows that even as the banking system is consolidating, we are beginning to see financial disintermediation. You find Dangote, MTN, and others issuing their own paper in the market. You have United Capital and others carrying out the issuing house activities. And now you're going to have cannibalization of the banking system because of the incursion of fintech companies and the telcos into this space. What does this mean? We are going to see an increase in velocity of circulation of money. We are going to see a much more efficient payment and settlement system. And all of this drives growth and activity. For example, in Ghana and in Ivory Coast and in Kenya, mobile payments are 3 times in volume than normal banking payments. And that's going to happen here, whether we like it or not. Sooner or later, you're going to see that. And when that efficiency in the financial system emerges, it's going to be accompanied by massive growth. And anything less than 6 to 8% growth in the next 3 years is suboptimal. And Nigerians are, unfortunately, if that doesn't happen, we are going to get poorer by going to bed.
Mr. Rewane, nearly 60 years, nearly 200 million people population, financial inclusion and penetration is still such a very low ebb that today we're still chasing folks for deposit. And it looks like for some folks, for some Nigerians, it doesn't become a natural thing to have a bank statement, to have a pension account, to have insurance. So with nearly 60 years of having a financial system and market, why is it still difficult to get people to be part of the market state where you and I are seated today?
Because you don't understand that the informal economy in Nigeria is about 30 to 35% of the total economy. As long as there's an informal economy, which people are outside the system or they are not screened into the system, you will not see all of these things. For example, the Lagos State Governor says that only 700,000 Lagos residents pay taxes in a population of 14, 15 million.
You gave everyone some heartbreaking, perhaps some folks missed that on the platform 3 days ago. Yeah. Now you're talking about 700,000, quoting the Lagos State, current Lagos State governor, paying tax out of about estimated 9, 10, 12 million, 15 million people. Any other data that could be heartbreaking?
No, not only that. Here? Only 110 Nigerians in Lagos pay more than 10 million naira tax a year.
For all the big houses
everything.
And whatever we have, and the big estates.
And all the sirens and all the big Jeeps and Rolls Royces, only 110 people pay more than 10 million naira. Only 700,000 Nigerians resident in Lagos pay taxes.
So when we talk about the financial system...
The financial and social burden of Lagos is on the shoulders of 700,000 residents.
A few of us who are registered, you and I, who are in the governor's book.
Just imagine if the financial collection was improved. Just imagine if there was total inclusion. The tax revenue in this place would be amazing.
How did we run a financial system of this country for nearly 60 years and we have such dismal data on our hands, Mr.
No,
Rewane?
because everybody's excluded. You see, what we're running is
an economy of exclusion.
Yeah, it's a club. It's just, everything goes. So now that people are being held accountable, the net is increasing. So you don't have to increase the tariff rate. All you have to do is to make the net wider.
So if you look at the VAT, for example,
yes,
in Lagos, so VAT technically is coming from far less number of Lagos residents.
No, VAT is a benefit tax, so you can't avoid it. Whether you like it or not, if you buy anything, you pay VAT. But it's personal income tax that I'm talking about, 700,000 people. Now, but what is more important is that the people are saying, yes, we would like to pay taxes, but we want to know what you're going to use our taxes to do. So if we cannot see the impact of what we are paying, then there's no motivation or incentive to pay.
Is that part of the reasons why folks find it difficult to be part of the financial system, have an insurance, have a life insurance, have a property insurance, and what have you?
Yeah.
And where these insurances or whatever exists, like land use fees, they don't want to pay.
No, the truth is that, you see, you're looking at the savings mobilization. Insurance, pension, deposits, all of this is savings mobilization. Now, how do these savings and surpluses go to sectors of the economy where there are shortages? There's financial intermediaries in between. Now the central bank and everybody say, no, you guys go and lend. And the banks are saying, we can't lend because the place is too risky.
We're scared.
Yeah, so let's de-risk it. Let's do the infrastructure. So you must see it in the context of a transition. Transition towards higher growth. Transition towards macroeconomic stability. Transition towards institutional development. When all of these things come together, there's no magic wand. It takes time. And you must accept that the followership has as much a role as the supposed leadership. So Nigeria is led by its followership, not led by the leadership.
Is that what you referred to 2 days ago as the mental discipline?
Yes, the mental discipline to execute, the mental discipline to accept the reality that this country is a former rich country.
For you, is the reality that we should pay higher price for petrol?
No, for me, it's a reality that we should pay market prices for everything.
Which include electricity?
But you don't want to disrupt things. We need to do it gradually, right? And that the government has a responsibility to spend and invest efficiently so that people can see what they are paying for. If they don't see what they are paying for, then there's no incentive to pay.
We've had some very grand ambitions for the financial markets place, and one of it was the FSS 2020, Financial System Stability 2020, under Professor Chukwuma Soludo, then central bank governor, about 12, 14 years ago, and we planned to build the Lekki Financial Corridor after the Dubai Financial Markets, DFM and others, be the hub for financial markets in Africa, trying to upstage Johannesburg, and out of it, and this idea or program technically in the water as we speak. Was that an idea good, too early?
No, you see, the thing about dreams is that when you wake up, reality. So Vision 2020 and FSS 2020 are dreams and visions. The point is that at times, if you wake up, the dream comes true. At times you wake up, dreams don't come true. The only way to make dreams to come true is that there's work to be done. Those were really fancy ideas. And I think Chukwuma Soludo also went with the unbalanced growth theory, bank capitalization trend, but in between there were disruptions. There was the financial meltdown, there was this. But the question is that did Nigeria learn from the lessons of the past?
I wanted to ask that question. What were the lessons for you looking at those ambitions like the FSS 2020, for example?
The lessons for me is that talk is cheap, dreams come, whether you don't have to work to dream, but the work is to convert dreams to reality. And that amount of work, which I call the mental discipline as well as the physical output, needs to be led and driven. We have to begin to accept that this is not a natural wealth economy. Everything is about sharing oil revenue. It should be a produced wealth economy. So when we go there and we say, we produce so much cocoa, we produce so much sesame seed, we produce so much of that, then we can share the result of our production. But if we extract and think we want to share the extraction, it's a world economy. In any case, oil is going to become obsolescent. The population is growing. People are mentally lazy. And the leadership has also become lethargic. So what we need at this point, intellectual honesty. People have to be honest. Leadership has to be honest and tell the people, this is the truth. No playing of games with anybody. And then the people have to, the credibility gap has to be bridged, and then people have to know that they must work. So it's not what we say, it's what we do. We must lead by example. We can't say one thing and do the other, because people can see, social media, they can see everything everybody's doing, right? So what my outlook is that there's optimism, there is potential, and we had a potential. I think that we are going to get there, but we have to make the hard choices, and we need to fold up our sleeves and work. People are tired of excuses. Nobody wants excuses.
All the time we talk about economic
Potential.
economic growth and development plans. For example, the current ERGP, which is still on track till next year, the Obasanjo's regime's needs, and the flip side, which is for the states, the SEEDS. They will have the late Sonny Abacha's Vision 2010. They will have the Jonathan's administration's Vision Transformation Agenda and Vision 2020. Then you put it all the way back a little bit to our structural adjustment program of the Bangida era, and we'll move all the way back like that. So if you look at all of that, where do you see any of these documents over the years putting the financial markets and the system at the heart of it? Because we need to finance it. Like the current ERGP, someone has to put the money on the table. It's not just about policies.
No, I think the reality is that the development plans of the past, which were plans, are different from visions and what you have today.
You distinguish in
first, clearly, first, second, and third development plan were plans that were articulated with a lot of input and hard work.
Rather than the latter
days. These are days of SMS and, what we call the calculator generation. That time people were using log tables and slide rules and all of that. There was a lot of work. It was rudimentary, but it was solid. Now, the thing is that we've got to the point where we have to decide that in the national income identity equation, which is government expenditure, consumer spending, and investment, the strategy for growth in this country is going to be investment-led. Investment-led means that the government creates what you call an enabling environment. The consumers are willing to spend. The government is to ensure that we enforce contracts and make sure that everybody does what they're supposed to do, law and order. Then investors will bring their money, employ people, and see the impact of that. Those three put together will allow you to achieve those goals, assuming that you have external balance. The big risk we face today is that our external balance can be threatened by any shift in the price of oil, any shift in the production of oil. And so the things outside our control are more than the things within our control. And the earlier we accept that that is the situation we are in, the better, both at the followership level and the leadership level. We are not in control of our economic destiny. Our economic destiny is probably in control of us.
Do you think the banks are under very serious pressure, historically speaking, bearing the burden of a fiscal economy that is structured largely towards rents and all of that?
Well, rent is one thing, because rent is not profit. Rent is actually theft, right? But we leave that. But
nicely put.
Yeah. The reality is that this is a bank-based economy, transitioning to become a market-based economy. You can't have 13 billion or whatever, 13 trillion naira market capitalization, and the banking system is multiples of that. Everywhere in the world, the markets are much bigger than the banking system, right? So we need to have that situation, just like in the US, where the Dow Jones and the S&P 500 are multiples of total banking assets on its own. When we have that system and we've transitioned from a bank-based economy to a market-based economy, where interest rates will determine not only rates of interest on deposit, but asset values in terms of fixed income securities and equities, you will see all of this will come together. So now you have MTN quoted, you have Airtel quoted, you have Dangote quoted. In another 2-3 years, you'll have maybe the NNPC and the JVs and all that quoted. People will now begin to invest, and they can now source money from there to expand productivity. So it's not a bleak picture. It only shows a picture of an economy that has challenges, but more opportunities than challenges.
You believe that this market street, when I mean this market street, fixed income, debt, derivatives, commodities, is where wealth creation really is, if you speak specifically to commodities exchanges?
Well, I think all of these are put together. You see, the whole thing is that the world is becoming commoditized, as it were, right? And people are trading. People are trying to hedge against risks. People are trying to price. Airlines are trying to buy jet fuel in advance because we don't know whether what happened in Saudi Arabia would spike oil prices. But you see that after that Saudi attack, prices went all the way to $70, and it came down. Today it's 57, 58. Why is this happening? Because the global institutions have now learned how to take shocks, and they've built in things that they have become much more sophisticated based on an efficient market hypothesis. So the efficient market hypothesis is that values are efficiently priced, and sophistication means that we can price in the risks and the vulnerabilities that happen, and so there's stability. So the financial system of the world and that of Nigeria is not going to be suffering from those shocks.
On a final note, I will talk about the future of Nigeria's financial system, 59 years, 60 years behind us, and we'll look at the next 60. If you look at the central bank, the SEC, and other regulators in the financial marketplace, what is your outlook and what more do you think they should be doing, what they shouldn't be doing moving forward to deliver part of what you just talked about over the last 30, 45 minutes?
I think, to be honest with you, the financial regulators are focusing on stability, which is their primary responsibility. Stability, safety, investor protection. Now we've got to lift that, go beyond that to see how we can add impetus. Where we can actually, not just intervention the way you're introduced, where you can actually encourage by moral suasion, by creating incentives and all of that, by collaborating with the private sector to ensure that we get maximum utility from what we are putting out there. Not just enough to mobilize savings, but to ensure that the savings become investment and the investment becomes inclusive and that output increases. But that's why you have the theory of production, output, and prices.
Mr. Rewane, thank you so much. A very nice way to wrap up the week of this independence because this is where it all started. Just across the road from us, the former headquarters of the Central Bank of Nigeria, 1958.
Yes.
Tinubu Square.
And you could see that all you have there is the big vaults where cash was being. Now there's no cash. Now you have POS, you have electronic payments. So no more
things have changed.
No more bullion vans.
No more bullion vans.
Frankly.
Surprisingly, we hardly hear the sirens of bullion vans anymore. We're missing them on the street. No. This crashed and did a major damage to my car 12 years ago. And I raced after them. I don't want to, that's a story for another day. At my own risk, it was a Saturday, and that's a story for another day. But a lot of Nigerians have a lot of tales to tell around bullion vans.
Yes.
Now they are gone. We've moved a lot since independence.
I know.
Thank you.
Congratulations.
It's good to have you here.
Thank you.
Bismarck Rewane, the CEO at Financial Derivatives Company and a member of the Economic Advisory Council of President Buhari. Of course, Bismarck Rewane's team will be inaugurated. Of course, we are looking forward to that as soon as President Buhari returns from South Africa. Of course, starting his 3-day visit to his counterpart in South Africa's most advanced economy, South Africa. President Cyril Ramaphosa is the one hosting President Buhari to a number of meetings over the next 3 days to try and smooth diplomatic and bilateral relations between the two biggest economies on the African continent. That's one big story that everyone is following. President Buhari will speak not just about xenophobic attacks in South Africa and, of course, a bit of a retaliatory issues here in Nigeria over the last couple of weeks, but he will speak more about how to strengthen economic relations between the two big countries. Of course, these two big economies on the African continent, the number one and number two, are facing serious challenges in recent times, and these challenges are not yet over. The reasons are simple. There are a few things that are common between Nigeria and South Africa. Both are commodities dependent. Nigeria on agriculture and oil, South Africa on mineral resources. So this is a very tough time when you look at commodity price cycles for major economies on the African continent around the world.